This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time. Listeners of today's program might have an interest in value stocks similar to those Tracey shared today. If you'd like access to her Value Investor Portfolio service, which includes real-time buys and sells, market insights and commentary, visit www.zacks.com/valueinvestor or call toll-free 1-888-775-8348 between 10 a.m. and 6 p.m. Monday through Friday. Outside the U.S., call 1-312-265-9309. Again, that's www.zacks.com/valueinvestor or toll-free 1-888-775-8348. Outside the U.S., 1-312-265-9309.
Welcome to this week's Value Investor Podcast. I've been thinking a lot about what makes a cheap stock. And I know that a lot of people think a cheap stock means a stock that's, say under $10. They look at the monetary value of it and think that that means cheap. But really, to me, what a cheap stock really means is that its fundamentals are cheap, that it's trading below what its peers are trading at based on its valuations, and it's probably trading below what the overall market is trading at. That's a true value stock. So you could have a value stock that's $100, you could have one that's $1,000 a share, and still be considered cheap. So I was looking around just to kind of get a gauge on what is actually cheap out there right now. And that has really good fundamentals because I always want the combination of the two because there's always going to be cheap stocks out there that, everything else is not looking good. So I wanted the good fundamentals. And for me, that meant why not start with the Zacks number one ranks? Because that means if it's got the number one rank, it means that the estimates are rising and something pretty good, especially recently, is going on if those estimates are rising. So we're just coming off of earnings season and most companies have reported now. And so the number one ranks are kind of interesting because it's those companies that did something good during the earnings season and they might have even, not just beat the last earnings report, but also maybe raised full year guidance. So those are the ones I want to look at. So I found 3 stocks this week that I feel are interesting and they have good fundamentals and they are also cheap compared to the overall market. And they're all in different industries. So let me just start off with talking about the first one, and it's Cooper Standard. Its ticker is CPS. They're headquartered in Michigan. They're an auto supply maker, or like auto parts guys. These guys are not as well known as the auto manufacturers themselves are, but of course they play a key vital part in the auto industry. Cooper is a leader in the sealing and trim segments. They also do fuel and brake delivery systems. And they also are one of the biggest manufacturers in North America of the fluid transfer systems industry. So they're in a whole bunch of areas that are vital for the cars. They don't pay a dividend and they have a market cap of $1.8 billion. But what I like about them is that they have a good mix of both the cars that they manufacture for, as well as the light trucks and the SUVs. And as you know, the SUVs have really exploded. Those smaller trucks are really hot right now. Because of the construction picking up and with the fuel costs down, everybody's buying those SUVs. So the analysts expect them to kind of have a good run here, even though overall auto sales might be topping. They saw margin expansion in the second quarter. They're cutting costs to try to keep those margins high. So I like all of that. 2016 earnings growth of little over 10%, and 2017 is still supposed to be good at about 8%. The estimates were raised big after they beat by 52 cents in this last quarter. That was huge beat. And one of the analysts actually said they're firing on all cylinders. So let's see, how cheap are they? They have a forward PE of 9.8. So I like that it's under 10. That's really cheap for this market. We keep hitting new highs in many of the indexes. So to get a PE under 10 is great. They have a price to book of 2.6. I look for price to books under 3. as a sign of value. So they fit right in that parameter. And as an additional bonus, my favorite value criteria, price to sales, they have a price to sales ratio of 0.5. If you remember, I look for price to sale ratios under 1. It's a little bit harder to fudge the numbers on the sales side. So if you can get it under 1, that's real cheap. So all of those metrics look really good. This is clearly a value stock. I think the auto sector is being ignored by most investors because they feel that we're at peak auto and that things are basically done, but you can get these kind of stocks cheap. It's something to keep in mind, especially for longer term investors. Okay, moving on to another group that's basically totally being ignored by investors, and this company is called Arris Group. It's ARRIS, and the ticker is ARRS. Now, they make video equipment, especially those set-top boxes you get for your cable, the cable modems and all of that. I know it doesn't sound that glamorous, does it? Why do I want to own? I don't like my cable provider anyways. Why do I want to own the company that makes those little boxes? Well, almost everyone has those little boxes. Now, the fear with this company has been that we're going to get rid of those little boxes. We're either cutting the cord or there's going to be new technology that basically takes away those cable modems some way. Now, the analysts all think that those fears are overdone, that yes, technology is changing and this area will be changing, but they think Arris is on the cutting edge of the evolution that's taking place with these video devices and with all this kind of pay TV and Netflix and Hulu and all of this, and that they will be changing as the industry changes, and that it will take several years, at least at the minimum, for any kind of changes to happen with the actual cable modem boxes. And that if the FCC, somehow puts in new regulations, regulating these boxes or whatever, that it's, again, going to take several years for this to go away. And in the meantime, sales are exploding. Their sales in the second quarter were up 38% year over year. Internationally, they were up 32%. They saw improving sales in Canada and Europe. The stock is really cheap here. They have a forward P of 11.1. They have a price to book of only 1.8. Again, that's under the 3 that I look for, well under. And their price to sales is right on the 1 level. So I still like that. It's not as cheap as Cooper is on the price to sales criteria, but that's just kind of an added bonus if I can get that price to sales. So this is a cheap stock, massive earnings growth. This year is supposed to grow earnings 36%. Next year, another 13%. But again, everybody is dissing it because they have these fears that these cable modems are going to go away. So, if you're willing to take a risk and you're getting it cheap, so this is one to keep in mind, a little bit riskier, like I just said. But value investors like to go into areas that other people are ignoring or hate or, can't stand or things like that. So this is one to keep in mind. Okay, our third stock this week is a retailer. And it's kind of interesting that I'm picking one because we all know the problems that they've been having. But this one is a big international focus. It's Deckers Outdoors. Its ticker is DECK. And I really kind of wish they would rename themselves because every time I hear Deckers Outdoors for years and years, I'm like, oh, do they do, like lawn furniture or camping or something like that? But no, these are the guys who make the Uggs, and they make the Uggs boots, which is their famous footwear. Now, they've been expanding outside of just the winter months because that's when they used to make all of their money off those boots. And now they've tried to emphasize more of the spring, summer. They actually had sandals and wedges and rain boots out, and they're expanding on their men's line too. So don't go thinking like, oh, that's a woman thing. What do I know about that? Because the men's business now makes up about 10 to 12% of the company's revenue. And they've been broadening that to include athletic and casual footwear. So men's is a sign of strength. They also have children's, and they have lines of shoes outside of the UGG that are very popular. They have the Teva and the Sanuk brands, and those are each about $100 million a year in revenue and have big growth potential. The Tevas are really popular for more of the people, like a little more outdoorsy, and they're basically comfort wear, very comfortable shoes. So there's areas to grow there in addition to growing their actual UGG brands. Now, they operate some retail stores. If you're in some major cities globally, you'll see a retail store. Otherwise, they sell wholesale through the department stores. And they've been struggling a bit. First quarter, same-store sales were down double digits. This year, fiscal 2017 is considered a transition year. They've even said that. So this one, kind of like Arris Group, is a little bit riskier. Inventory was up 26% year over year. You don't want to see that with a retailer, but hopefully they get rid of all of that by the holiday season. They are expecting, holiday season, their big time. So we'll see what kind of happens there. Fiscal 2017 earnings this year is expected to be down 4%. Again, this is a transition year while they work through some of these issues, but it's expected to rebound next year. Analysts really like Deckers because of the big brand. And if I can get it cheap enough, I might be interested too. Now, is it cheap enough? They are a value stock, but I'd like it to go a little bit cheaper before I would really dive in. But if you're interested in the retail side, it's one definitely to keep on your list and to watch. Their forward P is 14.6, so it is under the 15 that I look for. But again, if I could get it a little cheaper, 12 times, 13 times, I'd like it even more. Their price to book is good at 2.2, so that's under the 3 that I look for. And their price to sales is at 1.1, a little bit over the 1, but not so horrible. I still find that to be very attractive. So this stock is off of its highs. It does have the rising earnings estimates right now, even though this is a transition year. So it does have the Zacks #1 rank, but you're going to be taking a little bit more risk here. You're going to get a big global international name. They make a lot of their revenue overseas. I think it's like a third of their revenue comes from overseas. So they're a well-known brand. So keep that one on your radar and don't discount all of the retailers. I've been kind of looking around at a bunch of those. I just did a Movado for a bear of the day. So the watch area is still having some issues because of the wearables and because of a downturn in the luxury market. But I also just covered Burlington stores as a bull of the day. And they're not cheap. They're trading at 28 times, but their numbers look fantastic. They also had a beat and a raise. So look around the retailers. There might be some other value stocks in there or ones that will start to see improvement as we come into the holiday season, because you can't count out the consumer for forever, and there's some really good brands in there. So keep those in mind. So again, the 3 stocks this week that have the Zacks #1 ranks, and they are all value stocks. So they're definitely ones to keep on your list if you're looking for value stocks, are the Cooper Standard, which is in the auto industry, CPS. Then you have the Arris Group. They're making those set-top boxes for your cable. And they are ARRS, and then Deckers Outdoors, which is UGG, but their ticker is DECK until they change it to UGG, which is what they should do, but they haven't done it yet. So keep those 3 on your list, and I'll bring you some more stocks next week in the Value Investor Podcast, because there's always value out there somewhere. I'll see you next week.